Hello everyone, this is Christian with Random Property Group, and today I'll be walking through our hotel development model. And I believe this model is a great tool for assessing the financial feasibility of a hotel development project, and in particular, I believe the model does an exceptional job at bridging the gap between more granular analysis and more high-level preliminary type underwritings. So whether you are a first-time underwriter or you're someone who's used to screening several deals in a month, if not in a week, this model will address any sort of concerns that you may have and also those of potential stakeholders. So if you're looking to underwrite a deal or go into a deal that requires outside equity financing or debt financing, I believe this model does a great job of one, pinpointing any risks associated with the deal, and two, has enough flexibility to showcase how you can mitigate those risks, whether that's through financing, whether that's through change of operations, that sort of thing. I think the model addresses all of those concerns effectively. Jumping into the model features 11 tabs, 6 of which are input tabs, 5 of which are output tabs. So the input tabs are filled in light blue shading, and the output tabs have this darker shade of blue. And so starting off with the summary tab in the top left corner, we have property information where you can input any relevant property information. And because many hospitality deals, despite having sponsors located in the US, tend to be overseas, we do allow for conversion. So in this particular case, anywhere you input a square footage amount, the model will automatically convert to square meters. So for example, here we have gross square footage, and we see that the model is converting it to square meters. Beneath the property information section, we have investment assumptions, which allows you to choose the disposition month, the market cap rate at stabilization, the exit cap rate, the NOI method, and in particular, there are 4 ways to capture NOI in this model. And so we have annualized, forward 12, trailing 12, and trailing 3. Annualized can also be thought of as in-place NOI, so this will take month 60 and multiply it by 12. Finally, in the investment assumption section, we have GP equity contribution and LP equity contribution, which will inform the output for the partnership returns tab, which houses the waterfall. We have construction financing assumptions, which is what you typically can expect. Here, we also included a cash sweep, meaning that anytime there are positive cash flows, you can take a percentage of those cash flows to pay down the capitalizing interest. So if I were to change this to 100% of the positive cash flows while the loan is outstanding will be allocated toward paying down that accruing interest. Next, we have the permanent financing assumptions, and here we have a toggle whether you want to have the permanent refinance or not. And so if I toggle this to no, we'll see that there are no longer any permanent financing proceeds here, but we'll set this back to yes. Here we also have the refinance month. So while many models typically will assume that refinance occurs at stabilization, what we've increasingly seen amongst the sponsors that we work with, our clients, is that they want to be able to underwrite a buffer, meaning that even though the property may stabilize, in this case, the property is stabilizing in month 36, they may want to assume a buffer of, let's say, 3 to 6 months. So let's change this to 42. And now the model is updating accordingly. So the model accounts for that, the construction financing being outstanding even longer, and how that affects the investment returns. Here we also have the NOI method, which showcases again the 4 aforementioned ways of calculating NOI. Here we have a valuation cap rate. So this model particularly works with 3 different cap rates. The first one was the market cap rate, which will inform the development spread. So in this particular case, we have stabilized return on cost of 13.45% with a market cap rate at stabilization of 10%. That allows us to calculate the development spread. We also have the exit cap rate that, of course, will drive our sales proceeds. And then we have finally the valuation cap rate. And so the reason why we have a separate valuation cap rate is because a lender may choose to be more conservative with valuing the property. And so let's say you want to showcase a more conservative assumption, we can change this to 11%, and the model will update accordingly, but only there. So you can see how your financing proceeds changes under those circumstances. When it comes to assessing the permanent financing proceeds, there are three loan constraints in play. We have the minimum debt service coverage ratio, minimum debt yield, and the maximum LTV. The permanent financing proceeds that the model will return will be the most conservative value. And so this is being calculated using a min function. So here we see that the loan is being sized by the LTV amount, and so the resulting permanent financing proceeds is $15 million. Here we have net loan proceeds, which is just the difference between the permanent financing proceeds that you receive and the repayment amount at once the construction loan comes due. And then beneath the net loan proceeds, we have the assumptions for the permanent financing. So the interest rate, we have a functionality built in for interest only period, as well as the amortization, of course, maturity, loan origination fee, exit fee, and prepayment penalty. Next, we have our sources and uses table, and this is informed by various assumptions in the model, including the development budget, of course, and the financing assumptions here. So we can see that the LTC we have set is 65%. That's populating here in the model. And in particular, the sources and uses table is broken out by the whole dollar amount on a per key basis, a per gross square foot basis, and a per gross square meter basis as well, and the percentage of the total sources and uses. Beneath this, we have the total development budget, which is pulling from the development budget tab, which we will review shortly. We also have a project timeline, which highlights key milestones in the deal, ranging from land acquisition to first loan draw, refinance, stabilization, disposition, and so on and so forth. We have a key mix, which we will discuss in greater detail, but that's pulling from the key mix tab, and the model allows for up to 20 different key types, as many key counts or as many keys per key type as you would like, the ADR and the square footage and square meters, so on and so forth. In this top right corner, we have the stabilization. So we have our pro forma snapshot, but we also have, in particular, we can look at the pro forma at stabilization, at refinance, and at sale month. So again, if I update the refinance month to, let's say, 42, we can see how the pro forma is changing based on these different periods in the investment. And so we can see that here. Here we have a disposition summary. Some people call this a value creation summary, but this just juxtaposes the project costs with the sale proceeds. So we can see that for this particular deal that we're underwriting, we have a $7 million change, which is the delta, the variance between the sale proceeds and the project cost. And we can see that on a key basis, on a per key basis, a per gross square footage basis, and a per gross square meter basis as well as on a percentage change. Here we have our return summary. So we have our unlevered return, so on a capital structure neutral basis. We have our levered returns, which accounts for debt, and then we have our partnership return. So this is the returns after flowing through the waterfall, which is outlined on the partnership returns tab. Here we have a small graphic, so we have this chart, which is just meant to showcase in a visual way as opposed to numerically. Numerically, we still have it here, but it's meant to showcase the development spread visually via this chart, and so that will update accordingly. Here we have a sensitivity analysis, and we have the optionality to sensitize these 6 outputs based on the disposition month and the exit cap rate here. And then finally, off to the right, we have stabilized occupancy assumptions. So what we have seen with working with different sponsors is, particularly looking at a deal we recently we've been working on for a hotel acquisition in the Northeast. The peak season for that particular hotel is during the fall foliage months. So typically there will be a spike in occupancy during September, October, and November. And so we wanted to incorporate the flexibility to change the occupancy. So as opposed to just assuming one stabilized occupancy rate, you can choose the occupancy rate based on the month that we're in, which again allows for that flexibility and to account for peak times. And then finally, we have our stabilization assumptions. So the operation start is based on a manual input, but that would obviously be informed somewhat by the construction end. So construction end here occurs in month 18, and so operation start is in month 19. But we also want to account for a stabilization period. So we have that optionality built in as well. So we've set the stabilization period to 18 months, which results in the stabilized month occurring in month 36. And we have an occupancy adjustment here. So if we take a look at the project timeline, operation start, the occupancy is 35%, and that occurs in September, despite our occupancy assumption for September being 50%. The reason why it's showing 35% is because we have this downward occupancy adjustment set to 15%. So if I change this to 0, our project timeline occupancy will update accordingly, and now occupancy during the operation start is going to be what we input here. And so this is just useful for if you want to underwrite more conservative assumptions as it pertains to stabilization, you can do so here. Next, we have the key mix tab, and on this tab, we can input the different key types, how many units per key type that we have, the ADR, the square footage of each key type, and then we have some output metrics here. So we have the square footage here, we have the square meters here, the total square footage, total square meters, annual revenue, the ADR on a dollar per square foot basis, as well as on a dollar per square meter basis, and then finally the percentage of the total. So for example, we have five we have five Suite A's, and so that accounts for 16.7% of the property, so 5 divided by 30 there. Next, we have departmental P&L, and so we can input assumptions for the various revenue lines associated with the property. So we have for F&B, event space, spa service, and minor operated department. And so here, for example, we can assume 25 people check in for lunch, the revenue per check-in, and the total daily revenue associated with that. That is the profit side that's the revenue side. From the loss side or the expense side, we have the profit margin here, which we can set. And so rather than assume or force you to input the number of, for example, the costs associated with purchasing straws or Tupperware or China or any sort of thing like that. Typically, most sponsors have an idea of what the margins will be, or it can make an informed assumption, an informed guess, and so we simply built that in like so. And then below here, we have the departmental revenue growth, which can be grown separately from the room ADR, the ADR growth. And so here we have the consequential schedules, and this is flowing into the output tabs. Next, we have the room P&L. And so on this tab, we can choose the ADR growth, but really this tab is being driven by the key mix. So this is where we inputted the assumptions, and then this is where the outputs are housed. And so we can see how this is evolving over time. We can choose our ADR growth, and then we can also choose our profit margin here. So instead of assuming any cleaning personnel costs X amounts or whatever the case may be, a simple input for the profit margin typically gets the job done, and so we have that built in here. And then we have supporting calculations, so showing the number of keys, and the number of keys will be 0 until construction is complete. We have the available days in a year, the available room per year, occupancy rate, occupancy room per year, and then we have the ADR and of course the RevPAR associated with the property. On the expenses tab, we have expenses are broken up into two categories. So we have undistributed expenses here and then fixed expenses. And then we also have non-operating expenses. But starting off with the undistributed expenses, we can input the dollar per year amounts, the dollar per month amount, the dollar per key per year amount. And then we also have the optionality to choose what proportion of that given expense line item is variable versus fixed. And then we have we have its separate growth rate for the undistributed expenses, and then we also have a property management fee as well. For fixed expenses, the key difference here is that these are fixed expenses, so there's no variable component. And so this will house things like insurance or property taxes, but property taxes actually has its own schedule because we want to be able to account for any property tax reassessment once the construction is done. So in this particular case, we just have a dummy assumption of 100,000 for property tax, and in year two, it doubles due to, well, after following 3% of growth in year two, it doubles to 206,000. And then we have non-operating expenses as well. And so we have FF&E escrow. And so for those of you who may not be familiar with that term, that's effectively the replacement reserves that you would see in multifamily. Here, we're just calling it FF&E, so furniture, fixture, and equipment escrow, and that'll be a percentage of departmental revenue. We have a base royalty, and then we have an incentive royalty based on gross operating profit as opposed to departmental revenue. And then again, just like on the room P&L tab, we have the schedule for the expenses broken out here. Next, we have the development budget tab. So this is where the development budget assumptions are housed. And so if we expand this section here, we can see the development budget. So the development budget is broken up into four main categories: the land acquisition costs, the hard costs, the soft costs, and the contingency, which is a percentage of hard costs. And so we can input up to 20 line items for hard costs and soft costs respectively, and we have 5 line items for land acquisition costs. And in particular, let's pivot to hard costs. We can change the projection type. So there are 2 types that we have built into the model: bell curve, and we have straight line. So straight line is when you amortize the amount. So we've got 10.35 million. We'll divide it by the development period, which is 18 months, and that will amortize evenly over the 18 months. Whereas for the bell curve, the costs that we realize associated with the hard costs in this case will climb to a peak and then decline at the same rate. And so we see that here. If you want to change that, that's as simple as clicking this drop down and changing it to straight line. And now we see that the costs are amortized evenly over the time period. And of course, we can choose the start month and we can choose the end month, and that will flow into the model seamlessly. And we can collapse this for a nice and clean view. Next, we have the financing tab. So we have the development costs, and we also have some checks built in to make sure that everything is calculating correctly. We have the operational cash flow, and then finally we have our equity draw schedule. So as typically expected with construction financing, we deploy equity first, and then we begin to draw down on the loan. And so in this particular case, we're drawing down in month 6. And so we have that here, and then this is when the interest will start to accrue. And we can also, if we expand these columns here, we can input our forward SOFR curve as well. And then finally, we have our permanent financing assumptions, which is what you will typically expect. So once this permanent financing assumption this month is reached, this refinance month, the refinance will kick in. So we see that in month 36, and we have our fee associated with it, and then we have our debt service here. So we have interest only set to 0, but if I change it to 12 months, our debt service will update accordingly. And so now we see that we're only paying interest for 12 months until the debt service kicks back in. Full debt service kicks back in, the amortization. And finally, we have our monthly cash flow tab. We have a quarterly cash flow tab, which shows our pro forma, and then finally our annual cash flow tab. And in particular on the annual cash flow, remove this here, we can expand. So we have our pro forma here, and everything from revenues all the way down to net operating income, making sure we have house profit in there. And so we see all of our expenses that we all of our inputs from the previous tabs are showing up here and being calculated accordingly. And so we can see, for example, percentage of total departmental revenue is one of these sections that I hid previously, and now I've expanded so we can see how our different revenue lines are how our different revenue streams, our income streams are contributing to total departmental revenue, and then we can also look at that on a gross operating profit basis as well. And then if you want to get rid of that, we can of course collapse this like so. And then on all of these tabs at the very bottom, we of course have our unlevered cash flows and then our levered cash flows as well. The final tab of the model is the partnership returns tab. And here you can change the waterfall structure. So in this particular case, we have a pari passu waterfall. For those who are unfamiliar with that term, that's just in proportion to the initial equity investment. So this assumption, this 10% GP equity contribution, is coming from this cell C27 on the summary tab. And so the preferred return is 8%. We can adjust the different tiers. There are 4 tiers here. And so we have IRR hurdles based on 12% IRR, 15%, and then 18%. And then we have our promote structure here. And then what we've also incorporated here is the distribution frequency. So we can change the frequency from monthly, quarterly, and annually. And so if I change this to quarterly, the distributions change. And then annually, we see it's only paid on an annual basis. And so that's everything I wanted to cover with the model. This is meant to be a baseline. Of course, if you require more granular analysis, we're happy to accommodate that and underwrite any specific business case that you deem necessary. If you are looking for something more simple, we can also build a model that is more simple, more preliminary, again, more suitable for those high-level analyses because we recognize that there's a wide spectrum of underwriting demands from different sponsors. Regardless, we would love to be able to underwrite your hotel development deal or multifamily development deal, retail development deal, whatever it may be. We have experience across various asset types and across various strategies. So whether you're looking to invest in debt or equity, we can assist there. Whether you're looking to buy a core stabilized asset or looking to reposition a struggling office asset in a secondary city in the Northeast, we can also assist you with that as well. But thank you everybody for watching. Please feel free to reach out at raynerpropertygroup.com to begin a formal engagement, or if you have any questions or inquiries regarding the model or working together,